Good morning, everyone. Welcome to the Macro Snapshot. We are Monday, December the 15th, 2025. This is the last sort of full week, really, of sort of active trading, I suppose, before Christmas, but it's quite a busy week. We have obviously some big central bank decisions, not only in Scandinavia, also we have the BOE possibly going to cut. We have the ECB that's going to be interesting. But what's really going to get the market's attention most probably is going to be the non-farm payrolls. We get both October and November data, so finally starting to get a bit of a read on the US employment situation. Then, of course, we have the inflation numbers starting to get those, which we haven't had for a long time. So we have US CPI here, you can see on Thursday. And apart from that, we also have retail sales tomorrow, which is going to give us more information about, maybe the state of the US consumer. Obviously, there's been a lot of chatter over the last, few weeks about the so-called K-shaped economy in the US. But let's just quickly have a look and see why this is important. Just because we obviously had the Fed sort of last week, but if we look and see what's happening here, the market's a little bit unsure whether the Fed needs to cut or will cut again. Obviously, the political situation going on, also the situation with inflation. Is the Fed not being aggressive enough? Is inflation going to pick up, which will prevent the Fed? So if we just look and see what's going on, we can see that in the January meeting, essentially the market is at this point anyway assigning over only about a 1 in 4 possibility of the Fed actually cutting in January. So the idea here is that it could be a pause. But really, when things also get interesting is in March, which, as you can see, is essentially a coin toss at this point. The market is assigning, a 50% chance of doing nothing, of being a hold, and then, a small percentage of doing, 50 basis points. But essentially, mathematically, it's a bit of a coin toss between a hold and cutting again. And so this week will give us, quite a lot more information just about what's going on. We also have speeches today from the Dove Miran. Keep in mind, he'll probably present a case for sort of continuing sort of dovishness and cuts from the Fed. But we have Williams as well speaking. And remember that his sort of relatively dovish comments a couple of weeks ago really got the market thinking that, a cut in December was a distinct possibility. So let's have a look and see today what he has to say. Is he going to say, well, okay, the balance of risks is now sort of equal, no need to cut in the future, or will he actually reinforce the idea that potentially the economy is weakening? So definitely let's listen to Williams today. And then, of course, we have Waller, who's influential, speaking on Wednesday. That's going to be of great importance. So let's just have a look and see. There's been a lot of talk about inflation. And just keep in mind that Powell, one of the things he was saying was that inflation was essentially not completely licked or non-existent, but he said that basically in the first quarter of 2026, in any inflationary effects from the tariffs would probably start to mitigate and attenuate a little bit, and that essentially inflation would be not perfectly at their target of 2%, but would gradually come down over the course of 2026. And he did believe that in terms of the affordability crisis, the best way out of that was to have a strong economy. And so it almost giving the sense that he was prepared to sort of run it hot a little bit, and he didn't think that the run up in yields, nominal yields of the long-term bonds was especially due to inflation. He thought it was just more sort of a healthy sort of growth. But let's just have a look and see what the market is pricing. We just looked at the FedWatch tool. If we now look at the SOFR going all the way out the curve, all to 10 years, you can see here the trough, though, is looking just at about 3.25% or so. So the market is still pricing, and you see here a diminution here of the implied yields you see on the right here. So the implied yield still, according to the market, will go down, somewhat. But it's just interesting politically to look. Just put here this is where Trump wants it. So you see this sort of purple dotted line down the bottom, which is at 1%, just to give you a sense of what Trump is pushing for. Now we know he has an aggressive negotiating sort of style, but this is the kind of pressure that the new Fed chair will be potentially subjected to, not only from Trump, but let's say from the Treasury, the US Treasury. And you see here there's a huge differential between what Trump and the Treasury Secretary potentially want and what the market is actually pricing at the moment. But in terms of inflation as well, kind of interesting just to see what's going on here, because if you look at the five-year forward sort of inflation, so this is really what the market is saying. In 5 years, what do they think sort of the 5-year inflation rate will be from then? So it's almost like it's 10 years. So medium-term inflation expectations, basically, and you can see here that has I mean, I guess broadly been coming down over the last year or two. Obviously, a few sort of bumps. But what we've seen here, you notice here on the right-hand side that the five-year forward inflation has been pushing up a little bit, which was indicating that the market is starting to get a little concerned about the long-term prognosis for inflation. But having said that, if you look at other indicators from the market, for example, we can look at the inflation swaps. Now, what this is here, you see the 1 year is this white one, which obviously spiked around, 2022. Everything's come down, and you see what we've got here is the different tenors. And broadly speaking, even the 1 year, you can see here how this has really come down quite a lot over the last, so let's say 3 or 4 months or so. You see that that was a concern of the market about short-term inflation, the 1 year, and then you've got the 2 year, which is the blue one. But as you can see, they're all starting to converge and have come down quite a lot. Which is a little bit of a different read from what we're seeing with the five-year. And some people are saying that the inflation swaps, because we haven't, that's priced on tips and the CPI, and because we haven't had a lot of timely data from the CPI up until, what's going to come out in a few days, maybe this market is a bit distorted. So that's going to be a very interesting one. It's going to be to look at inflation swaps and see whether, or just how it reacts to the inflation data. And another way of looking at that, of course, is just to see how this inflation swap curve just over the last week, you can see here that it's come down. So you see the front of the curve here. So this is really, you see here 1 year, 2 year, 3 year, and you can see here that that's really collapsed quite a lot over the last sort of week, and it's come down a lot. That's where it was, the yellow line, but you see the green line is where we are now. So inflation metrics as measured by market participants, a little bit of confusion here. And as I say, that's why the CPI this week will, enable, sort of certain members, maybe even Trump and Bissett, to say, hey, inflation is going down. It's not such a problem. It's attenuating. And that would sort of validate Powell a little bit. Or on the other hand, let's say, for example, we get a strong inflation number that could cause alarm bells and things like the inflation swaps. And obviously, the market then is going to reprice the curve and your sort of inflation expectations. So let's just look at a few markets here and see a little bit what's going on. Where are we? I think we can go here. So again, let's just look at a few markets. And just one thing, for example, it's interesting. There's been a lot of talk about non-US central banks. Let's say, for example, Australia, New Zealand, Canada, repricing, potentially even a cut in a hike in 2026 if global markets do continue to be quite strong, stock markets and whatnot. But it is interesting that, for example, over the weekend, we got from New Zealand the new head of the Reserve Bank of New Zealand, Anna Brennan from Scandinavia, who basically pushed back and said, hey, she wasn't convinced that rate hikes would be necessary. And you can see here, this is on a daily chart. You see on her comments, the New Zealand USD, the New Zealand dollar, the Kiwi actually sold off a little bit on those comments. So I think we just have to just wait and see how the data unfolds in terms of inflation. Again, as I said, we have in Canada this morning, there is inflation data. You see that the Canadian dollar has really strengthened significantly. You see, this is USD CAD. You can see that that's come, fallen, a lot, probably like a couple of percent or so, about 2.5% over the last couple of weeks. Again, based on this whole narrative that, a lot of non-US central banks are kind of done cutting. They're going to be in hold, maybe even possibly one hike over 2026, whereas in the US, there's this whole sort of idea of the differentials, and differentials, will favor sort of not the dollar, sort of other currencies. But it was interesting to see, as I say, the head of Reserve Bank of New Zealand pushing back and saying, that's not a given that we're going to be hiking in 2026, and we have to see the data. Anyway, all that to say that it starts today at 8:30 with the Canadian CPI data, and then on Thursday we have the US data. So let's see how all of that goes. Just while we're here on the currencies and talking about differentials, interesting to look at something like the US dollar versus the yen. We can see that the US dollar we all know that the US dollar has really been sort of pushing a lot higher than the yen. And one of the narratives is that the Bank of Japan will cut this week. I think it's on Thursday, and that the differentials is really starting to come in, and therefore that could cause the US dollar to weaken. Now, we've seen a little bit of weakening over the last couple of days, but I just want to share just a few sort of charts and graphics just about the Bank of Japan. So first of all, let's just see what's priced. We've got here the Bloomberg WIRP function, which works on the overnight index swaps. And indeed, you can see that for the meeting coming up on the 19th, in a few days, that the market is ascribing 91% chance chance of a cut. So at this point, basically 22 basis points are priced in. So the market is fully expecting a hike. Sorry, did I say a cut? A hike at this point. So yeah, for sure, the Japanese interest rates are most probably going up. But just want to do a little bit of historical context here. Just pulled out a few charts essentially about this idea of the differential. So classical theory would say that when differentials are closer, currencies will go in one direction or not. When they blow out, they'll go in another direction. So what we can see here, if we just look at just comparatively here, we see the Fed funds rate compared to the Bank of Japan policy rate here in the red. And we can see indeed that, the Fed obviously hiked a lot. If you go here looking below 2022, 2023, for sure, the Bank of Japan was on hold while the Fed was hiking. And then you see below here, you see this arrow pushing up at the policy spread rate. So the differential's blowing out. Now, is that going to favor the US dollar? Absolutely. And you can see here that the US dollar here went up. So you see here in this period, 2022, 2023, in general, it did go up. But what's interesting to note is that um, that's okay for the theory going up. It's like, oh, the differential's going out. U.S. interest rates are higher than Japan's on hold. Therefore, the U.S. dollar strengthens against the JPY. Okay, so far so good. But what we have to see here is that if you then look at the policy spread over the last, let's say 18 months or so, that's actually gone in the other direction. So let's look at this chart below, and you can see here this is the interest rate spread. And so for sure in 2024, there was the differentials over 5%, 500 basis points. And if we go all the way to today, and then, going into probably what's going to happen on Thursday, you can see here that that spread's coming by about 200 basis points or 2%. You say, well, therefore, obviously the US dollar would have weakened against the Japanese yen. No, not so fast, because if you look at the chart, you can see here that the Japanese there's been wobbles up and down volatility, but essentially the US dollar is still very, very strong at 156. Not as strong as it has been, it's come down a little bit, but it certainly hasn't collapsed. And you can see here that overall that's not giving us that information. So just to put it all together here, on these three charts, it's not necessarily a given that what's going to happen, if the US continues to cut once or twice and the Bank of Japan has some incremental hikes, will that interest rate differential narrow? Absolutely. Does that necessarily mean that the USD JPY will fall in value? I personally think it probably will a little bit, but we have to be careful about assuming that's a necessary correlation. And you can just see here, just put it all together. You can see here where the BOJ has sort of hiked. You can see here back there a few times. But again, this is against the US dollar. It's not necessarily the case that the USD JPY has fallen. So let's keep an eye on all of that going ahead. Now, just in general, while we're looking at the currencies here, let's just have a look here we've got the Dixie here, so the dollar index against mainly a little bit of Japanese yen, but mainly the euro and other European currencies. A pretty critical point here, you can see that we're at the 50% retracement here. You can see here that that's the 50% retracement. Again, it's probably going to depend really on what happens with retail sales. Is that going to be strong? That's going to be US dollar positive. Also obviously with the CPI and of course non-farm payrolls. If all of that stuff comes in kind of those three major sort of data points come in hot, there's no reason here why the US dollar cannot maybe have a nice bounce here off this 50% fib. On the other hand, if that data is a little mixed or on the weak side, for sure we could see further weakness, and we could see the euro sort of pushing high. You see the euro is having a nice sort of push much higher. Up here, it could get up to, let's say, the 118 or so. Although having said that, we have the ECB on Thursday. They're not expected to cut in any shape or form, certainly not expected to hike. But, pricing has gone a little bit more sort of hawkish recently. So let's just look at some of these bond markets. So if we look here at the yields, Just want to look here in Germany. So you can see here something like the, not so much the 1 year, but we look at the 2 year yields. You can see here breaking a lot higher over the last 5 or 6 days. You see here the 5 year yields breaking higher out of a range and the 10 year yields. So certainly bond yields sort of globally, but also in Europe, just using Germany here, have pushed a lot higher. And we've seen a little bit of sort of steepening of the curve over in Germany. So it will be interesting to see on Thursday if Lagarde pushes back and says, hey, the economy is doing okay, but, do we need hikes in 2026? Not so fast. So that's going to be a very interesting one to look at there. If we also look at just what's going on in the US bond space, we can see the 1 year yield actually has gone down because remember the Fed did cut a few days ago, but as soon as you start going a little bit further out the curve, you can start seeing that, on Wednesday, the 10th here, you see the Fed did cut. But further out the curve, you can see that, the reaction has been relatively muted. And you can see the fives, the tens here. Look at the tens here. Look at the 30s. So I'll just go through that quickly. Just note here, just as the yield. So the 1 year, pretty low. 2 year went down, but stabilizing. The 5 year down and coming back. Then the 10 year and the 30 year starting to push. So we're seeing a very significant sort of a steepening of the curve in the US. So here's the twos, 30s. You see coming up to a little bit of resistance. That's definitely been steepening quite a lot. And as I've been pointing out, something like the twos, fives has steepened dramatically. And that really what that's telling you is that the Fed, maybe is cutting once or twice more, but really the market is a little bit concerned, as we saw, about sort of potentially sticky inflation and possibly also, as Powell was saying, just a strong economy. The reality is there's going to be sort of tax rebates probably coming to a lot of Americans in 2026. It could be stimulus checks. So the economy potentially could be, very stimulated in 2026, which could cause a steepening of the curve. So who benefits from a steepening of the curve? One thing which is interesting is just look at some of the sectors. So if you look at technology, had a bit of a sell-off day on Friday, concern about the expensive valuations for AI and some of the tech companies. But it's kind of interesting. You look at healthcare, it's come down a little bit, but coming back. But really, just look at financials here. You see financials are pushing to out above the range. And just to go back here on the daily chart here, so you see financials very, very strong. So that's signaling, a relatively is a relative optimism about the economy, deal making, loans, but also potentially that steepening yield curve historically has been, a sweet spot for sort of banks and loans, as they sort of borrow at short-term rates and sort of lend out at higher term rates. So the steepening of the curve is, a good thing normally for financial. So let's keep an eye on that sort of divergence there between tech being undersold, underbought, and financials and a few other sectors really breaking out. So if we look at that, you can see here, the VIX pretty low levels here, had a bit of a pop on Friday just on that equity sell-off here, but overall at relatively supportive levels, indicating about a 1% move on a daily chart with the 16% VIX. But just have a look here at the ES. And you can see here, listen, it had a wobble, it is falling off, but at the end of the day, this trend, this sort of up channel is still sort of grinding upwards. So no huge technical damage done, still trading around highs. But what we are seeing is that the broader index is outperforming NASDAQ. You see NASDAQ here actually has fallen out a little bit below that sort of upwards channel. So that is something to keep an eye on. And what's very strong here is actually the Russells. You see the Russell here in the middle of this sort of upwards channel and potentially has a little bit more room to go. And that's been, so basically the small caps really liking the fact that interest rates may be coming down a little bit, maybe coming down a little bit, because remember that the differential between the Fed funds and the 10 years actually sort of blowing out a little bit. So what's happening here is that we're not getting a full transmission, even though the Fed is cutting interest rates, it's not really being transmitted into the belly and the long end of the curve, which ultimately controls the real economy rates. Your car loan, credit card payments, obviously mortgages, those have remained very high and sticky. And so that differential between, let's say, the effective Fed funds rate and the 10-year is actually going up. It's not fully being translated into and transmitted into the real economy, but in general, there is some kind of sector rotation here and a sense that maybe, the US economy will be stimulated by, the Treasury actions, maybe buying a lot of T-bills, which we're seeing, 20, 30, 40 billion per month, probably stimulus checks from the US government coming at some point. So, the Russell doing quite well. And you can see here something like relative performance. You can see the Mag 7s underperforming a little bit or something compared to, let's say, equal caps. You see the equal caps are pushing out. So we have things like the Russell equal weight doing much better than the sort of the Mag 7. So that's going to be interesting to see if that story continues to develop this week. And we're also seeing here that something like the breadth of the market is widening a little bit. You see here the percentage of companies trading above their 50-day moving average actually is sort of pushing. I mean, it had a bit of a down day on Friday, but in general, it's showing a little bit more breadth in the market. So possibly a bit of reallocation towards the end of the year, just money being taken out of some of these sort of the Mag 7s and just reallocated in some of the smaller caps and the broader market as such. Okay, what else did I want to speak about? I think that's about it, guys. Gold continues to be strong. Let's just have a quick look at oil here. Oil continues to be quite weak. And you've got to say here that, if you look at some of the moving averages and whatnot, oil is just finding it very difficult to get above the 50-day moving average. Every time over the last couple of months it's hit the 50-day moving average, it's being whacked downwards. So oil continues to trade heavy. Is there going to be a bit of support down here at the swing low, $56? It's possible, but overall, oil just finding it very, very difficult to get off the mat. And you have to say that there's still, even though the global economy is doing okay, and there are signs of a pickup in Chinese demand for oil, the reality is that there's still a concern that OPEC Plus has been overproducing, or at least that there's, the inventories are a little bit too high. We shall see. Not a place there. Just not a lot of positive energy here at this point. Gold over the weekend. Actually, over the weekend, let's just talk about BTC, because we're seeing here that the chart. I mean, the real question here in BTC is, is this sort of a bear flag? Very weak price action, especially if you're going to compare it to something like gold or something like that. You can see here that, the bear flag, it fell. This is a pretty critical moment here because, on the weekend here, you see on Sunday and Saturday to a certain degree, Bitcoin starting to, sort of push lower. And if you want to do any kind of fib extension here, you're certainly talking down 80s and even, down into the 50s and 60s. We're not there yet, but this is a critical moment here. And at a certain point, you'd have to say that, let's say 80,000 would have to hold. Otherwise, this will turn out to be a bear flag. That's certainly what the chart is telling me at the moment, that it is bearish price action. Okay, but if we just go back to gold, what can I say? Gold had a little bit of a down day on Friday, but it looks as though it definitely wants to retest those recent highs at 4,400. Central banks continue to buy. There is still the so-called debasement fears, that the US dollar is going to be the one which is going to be weakened if the Treasury continues to not show if the US government continues to not show fiscal discipline, too much issuance of bills, stimulus checks, et cetera, et cetera, et cetera. It looks as though the US dollar is, potentially weakening. So gold are pushing higher, and also silver pushing out again. Had a bit of a down day on the risk off on Friday, but looks as though it's pushing higher. Now, is it overextended? For sure. But at this point, the price action is the price action. And you can see here on the longer term, 20, 50, 100, 200-day EMAs, that this is still in a very, very bullish trend, which is also pulling up some of the other metals. You can see here that the ETF for platinum is pushing out to highs, and even palladium is starting to pick up a bit of a bid. Again, there's a bit of a risk off on Friday, but pushing much higher. So really one of the questions also for the metals is going to be copper. On Friday, again, stalling out at the 61% fib here, but as you can see, pushing up a little bit. And if that can clear this fib level at 5.5, you've got to think that copper might have a little bit more of a push higher. And just to give you a sense of where that could go, if we just measure out, let's say, a Fibonacci extension here, you can see that if it gets above the 61% fib retracement, we could push higher to even up to 5.75. So a little bit more room potentially to the upside for copper. Okay, guys, I'll leave it here. As I said, let's have a look at Canadian CPI today. That could be the beginning, or if that's a little bit hot, or at least higher than expected. this whole narrative of, some central banks maybe thinking about a hike in 2026, and therefore interest rate differentials with the US, that narrative could start to sort of take place. But we're not there yet. Let's see what happens at 8:30. Let's keep a look at stock rotation. The Mag 7 is going to be a little bit underperforming compared to, let's say, something like the Russell. And of course, as I say, we have speeches from Williams and Miran today. Thanks very much. Have a great day. Have a great week. And we'll be back tomorrow with the macro snapshot. Thank you.